Hi guys, it's Phillip Wong here. I got a surprisingly long question on Twitter this week asking me to explain how and why we regulate accounting information and how does this impact upon the capital market. I think maybe somebody somewhere has an assignment due. So in those movies about high finance how traders are always looking for some key piece of information to get the jump on the market? So it's pretty clear that capital markets are fed by information and particularly by accounting information. Obviously, investors need to know what they're buying into. But first off, what do I mean by the term capital market? And really, is it the same thing as the share market? Yep, it sure is, but it actually does include other sources of finance as well, such as bonds and other forms of debt. The simple definition of the capital market is anywhere where companies go to get the finance that they need to basically run their organization. So let's break it down. Why is information so critical to markets, and how do share markets come to the right price for any share anyway? Most of the time people will assume that because the share market is a market that there's going to be some form of supply and demand. But unfortunately those normal supply and demand curves don't work here. For most markets we have one set of people supplying stuff and another set of people consuming that stuff. But when it comes to the share market, it's not quite like that. And this is because any particular shareholder can be both potential supplier because they could turn around and sell their shares at any moment, and they could be a potential consumer since they could, well, essentially buy more and add to demand. So if we haven't got a set of supply and demand curves, how do we know what to pay for anything? It's not like these shares are worthless, and you do after all get dividends. Aha! Dividends. And there is your answer. You can find a net present value for those future dividends. Now, how do you know what the future dividends are going to be? Because it's not like you know the future. Well, there are two ways of figuring that out. You're going to have to make a guess based on the past history, and also you're going to have a steady supply of news. But essentially, those two inputs are just ways of guessing what the future will be. Just in the same way that wheat is a critical input for bread, information is also a critical input to the share market. But the market for wheat and the market for bread, those two things are not the same item. In this situation, you definitely do have the circumstance where there are different people who are supplying and demanding information. If you wanted more information, you could simply pay for it. So we can think of information as being a tradable good in its own right, again with its own supply and demand curve. The suppliers are the managers and the accountants who prepare the information, and they're just simply known as preparers, preparing the reports. The audience are the people who are consuming those reports. They're usually shareholders and investment analysts. These guys are simply known as the users because they're the ones who are using the information to make decisions such as buy and sell shares. Having different groups in this market means that we can have the usual supply and demand graph. But this particular time, the x-axis isn't actually quantity, it's quality of information. Think of it like this. If I give you a basic piece of information, such as the BHP profit for this year to the 30th of June was $1.9 billion, you wouldn't want to hear more supply of that same fact. To get more information, you would actually demand more detail, say by breaking down that profit figure by department or maybe by different mining operations. You wouldn't want to hear the same profit figure over and over and over again. It's about the quality of information as much as it's about the quantity of information. Here, we don't necessarily mean that more is better. And it's really not so crazy to say that good quality information does in fact cost money. Think of all the great sources of information out there, such as subscriptions to The Economist or IBIS World Reports or Bloomberg terminals. None of these are particularly cheap. Yet we have a problem here, and that is that information is sometimes considered to be a public good. Now, a public good is anything that is non-rivalrous and non-excludable. Non-rivalrous means that if I've got something, your consumption of that thing will not diminish my enjoyment of it. Non-excludable means that it's very hard for me to stop you from consuming the benefit of that good. In fact, there are plenty of examples of public goods out there. Think of things such as national defence, fire brigade, the construction of roads, running of courts and prisons, and many, many others. Out of this drops the free rider problem. And since consumers are able to find ways to consume the good, they start to say to themselves, hey man, why the hell do I have to pay for this? If I can get it for free, someone else can go and pay for it, thanks very much. This means it becomes notoriously difficult for producers to try and charge a reasonable price. And although you may have been able to consume that thing without paying anything, that does not necessarily mean that it was free to produce. This is known as the free rider problem, where since there is no incentive to keep providing this public good, since suppliers can't charge for it, they can't keep going on making losses forever, and essentially the entire market collapses. Market failure occurs and we are left with an undersupply of information, and hence we're going to start getting bad decisions in the capital market because people won't know what they're buying into. The knock-on effects of this are bad decisions in employment, and eventually it will affect the entire economy. Now, public interest theory has a way of beating this. In these situations, people pretty quickly realize that, well, we need these things, and it's going to be in the public interest if somebody just makes it happen somehow, by force if necessary. So people want their clean water and they want their road networks, and people will very quickly band together, form a government, raise taxes, use those funds to provide those services to the public, usually directly. But this isn't really going to work real well for accounting. I mean, suppose for a moment that you were a BHP shareholder. Would you really expect the government to send in one of their own accountants, do all the accounting work for the BHP managers, then come out with a government mandated truth about what the profit figure really is? Wouldn't it just be easier to ask the BHP managers to just do their own accounting? I mean, they're probably keeping their own numbers for internal purposes after all anyway, right? So instead of the government doing it for you, it's just far easier to ask the companies to produce their own financial reports. They are, after all, the ones with all the information. This effectively forces the companies to wear the cost, of course. So instead of the government doing the work for you, they just simply decree that all the companies are going to produce information at this certain minimum standard, and they're going to check to make sure that companies meet their responsibilities. Of course, companies can always go ahead and produce more information than they legally have to, but they must meet those minimum standards. This will create something of a bend or an L-shaped kink in the demand curve. So the demand curve will be vertical at that some minimum point, and everything thereafter will be completely horizontal. Users are happy to accept more information, but they're not going to pay an additional cent for any of it. So this public interest theory looks like a pretty good deal. I mean, it's good for companies and it's good for users. Companies are better off because capital markets are allocating funds more efficiently, and investors are much better off because they know what they're buying into. Yeah, well, not so fast. Of course, the details have to make everything complex. Now, the problem here is that the government isn't really sure as to where they need to set that legal minimum standard. I mean, what is the appropriate minimum level of information anyway? I mean, should companies report once a year? Well, that seems pretty reasonable. What about twice a year? What about quarterly? What about weekly? Should they be audited? Should all of those reports be audited, or only some? Should they be broken down by business unit? Gosh, should the companies have to disclose their cost of goods sold? Why not force them to disclose the gross margin on each and every product they sell? By the way, if you think that these demands are particularly reasonable, you should be aware that under the current accounting standards, gross profit is not disclosed, and in fact it's usually kept as a trade secret. And really we need to ask ourselves, is more information always better information anyway? Since the government doesn't really know where to set this standard, they're usually inclined to set it, at a kind of safe level, usually pretty high. Furthermore, there are certain users out there, such as investment analysts, who usually overstate, having a big whinge of the government about how they really need this information, otherwise they're going to go bankrupt. These guys are usually very well organized, and they can lobby the government pretty effectively to get what they want. I mean, why wouldn't they ask for more? It's not like the users are paying for it. That's the company's responsibility. So we can see in a strictly regulated market, there's ultimately a fairly high chance that you might end up with an oversupply of information, where the overall costs are outweighed by the overall benefits of providing that last piece of detail. I guess the big problem here is that we never really know what that optimal level of information is. How do we know when we've reached that efficient point? Well, we really can't. Of course, if you ask the shareholders, oh, it's never enough, we need to keep moving it further and further this way. But of course, if you ask the managers, they'd rather not do the work, and they'd rather not be so regulated. So, if you've made it this far throughout the video, the TLDR version is capital markets need information. Information is a public good, but people want a free ride on that. Without regulation, there could be a total dearth of information, and this would lead to complete market failure. So, it's in the public interest to force companies to report. But people are selfish, and they'll often beg the government for more and more regulation to provide more and more information. And so, regulated markets run the risk of oversupplying information. This is sometimes termed government failure rather than market failure. Thanks very much to the person who asked me this question on Twitter. I hope this overview helps you with your essay research. Also, I've got a big new project that's forthcoming, and you will see a lot more videos out of me coming out very, very soon. If you'd like to find out more, or if you've got a question for me, you can simply ask me. You can subscribe to this video and ask those questions in the comments below. You can also find me on Facebook, post that question to my wall, or you can simply tweet me at Tetracarbon. Happy study, guys.